Now we're going to pivot into Europe. And before we go into some of the more nuanced pieces to kind of pick them apart and look at them specifically, we just want to look at the aggregate and some of the high-level numbers, and we'll break it out in different pieces. So let's look at the Eurozone aggregate and start there. So consumer confidence actually got a bit worse in July. It was expected at negative 2.6%, came in at negative 4.4%. And when you look at some of the drivers behind that has been some of the COVID overhangs. You still have some political uncertainties. There's been a lot of strife back and forth and pushback in terms of lockdowns. So again, there's some confidence that has ebbed, but we still think that that's going to get better over the next few months. Where then when you looked at Eurozone manufacturing, was expected at 62.5, came in at 62.6. Eurozone services was expected at 59.3, came in at 60.4. Putting the composite at about 60.6. So you're seeing that, but they're also being driven on the underlying from some of the things that are driving the U.S. that really aren't the best drivers in terms of price increases, supplier delivery times, inventories. So some, again, when you back them out, it's still expansionary and it's still positive, but those are some of the negative impacts that we continue to see. And we're going to break them out over throughout the next, let's call it 10 minutes for this segment in terms of where that's going to shake out and how that's going to impact things going forward. Now, just looking at Spain real quick, because we haven't talked about Spain in a minute. When you look at PPI, I think this is the biggest or one of the bigger concerns coming from Spain. The PPI month over month was up 2.2% after being up 1.6% last month, and then year over year up 15.4%. So you're still seeing this inflationary drive because it's the producer price index. So that's going to have to get passed down at some point, and that's, I think, a bigger concern as we go through the remainder of the year. So then when we look at France, and everything came in pretty much along estimate lines. When you look at business confidence, it came in with expectations. Manufacturing confidence a little bit better. Production outlook was expected to be at 28. It came in at 20. And I think the outlook, again, is clouded by lead times, deliveries, backlogs, and that's, I think, a bigger concern overall than in previous times, which is a little bit of that overhang to that confidence. And then when you look at PMI, manufacturing PMI came in right in line. It was expected at 58.3, came in at 58.1. Services, though, was expected at 58.8, and it came in at 57. And you keep seeing, especially in Europe, services missing. And I think, as we said last week, and as I was talking about on Twitter last week, there's an overhang of wage compression and price increases because prices have continued to go up in Europe and wages just haven't kept pace. And if anything, they've actually compressed. And that's eating into some of that services that we've seen. And this is just another sign that it continues to reverberate through the system. And that's putting us with a composite instead of 58.4, 56.8, because the services is a bigger weighting, which again is drawing that down, which is a bit problematic when we're looking at, because France was supposed to be kind of on the up and coming, as with Italy, which Italy has done a little bit better. But then to wrap it up with Germany actually on the other side crushed it on the PMI with manufacturing expected at 64.1, came in at 65.6. Services was expected at 59.5, came in at 62.2. Composite was expected at 60.7, came in at 62.5. So that was a positive. But remember, there's some key pieces of that in terms of the issues that they've been having with supply chains, because it is an exporting nation. Backlogs, car construction has been a bigger problem, and that's showing. And the problems that should have shown up in the PMI, and again that don't, they get backed out a bit in the IFO in terms of what they come out with. So the IFO expectations was expected at 103.6, came in at 101.2, still good, but just not as good as expected. Current assessment was expected at 101.8, came in at 100.4. Business climate was expected at 102.5, came in at 100.8. So that's where you're starting to get some of that moderation that we've been talking about, that is actually starting to come through the system. With some of that, it depends on how you weight the data, is I guess what I'm trying to get across. And that's why it's always good to look at some of the different pieces of those data sets to understand what's going to be more impactful. Like when you look at Italy, consumer confidence was expected at 115.5, came in at 116.6. Manufacturing came in right in line at 115.7, and the economic sentiment came in at 116.3, well up from the previous 112.8. So that's when we look at some of the different pieces of, and we'll get more of the PPI from them next week. But that's, again, some of those important things to look at. Now, looking at the IFO data, this is just showing kind of where things sit in general in terms of manufacturing. So business expectations for manufacturing is getting a bit worse. And that's what I keep talking about, because they were really good. And now you're seeing some of those cracks are supplier delivery times, prices, which look good for PMI, but start to weigh on some of that sentiment, which is being picked up in terms of business expectations rolling over in the service sector. Now, again, construction continues to be very slow, and then trade is starting to roll over and actually go negative. And that's, I think, the biggest problem when you look at German growth and then European growth, is trade is slowing, and Germany is a net exporting country. And that's when you start to look towards the US and China, and we'll talk about how China and Germany connect back together, because there's a big problem as some of that slowing down impacts their movements. So then when you look at manufacturing price expectations, here you can see it's just everything is up and to the right. So some things are coming down a bit, but they're all still elevated and they haven't adjusted lower. And it's everything: manufacturing, wood, refining, chemicals, rubber, plastics, basic metals, plastics in primary form. Everything is showing a price increase on a percentage basis, and there's so much risk coming through, because all of this is going to come down into the manufacturing cost, because this is then going to become the consumer price, and that's where we continue to see those elevated levels. And that's why when we look at IFO manufacturing price expectations are back up at all-time highs and continue to stay up there with little to no expectations for movements. Share of sectors with falling price expectations have increased a bit, but you can still see just where that percentage lies. So then when we look at Euro area economy, it's poised to rebound. That's 100% accurate. That we are not saying that it's not going to rebound. It's just the rebound is going to be more measured versus what expectations are, given the overhangs that are starting to come back into the system. So then when you look at the Eurozone industry survey, percent business reporting material equipment shortages limiting production is at an all-time high going back to 1985. So this is the biggest issue. 22.8% as of Q2 2021 are experiencing some sort of equipment shortage failure that is limiting production, which is why when you look at some of these things that would be technically a net positive for PMI, this is a net negative for where some of this will actually transpire. So then when you look at the Citi Economic Surprise Index, you can see it continues to weaken, because you're just not getting the same juice to the upside on some of these different economic indicators. So then when we look at the ECB stepping up their the PEPP purchases in the last couple of weeks, ECB strengthened rates guidance after new inflation aim following strategy review, making it clear it wants to see inflation at 2% by midpoint of inflation forecast and durably thereafter before raising rates. So you're starting to see some of this convergence to, they don't want things to overheat too much. So you're starting to get this new strategy that wants to see inflation at 2% by midpoint of inflation forecast, but they're not willing to let it go above that. And that's when you're starting to see some of the PEPP purchases moderate a bit. But moderating is relative, because you can see that the purchases are going to continue to go up, which might prompt a discussion within the council on whether the euro 1.85 trillion envelope should be increased. And that's going to be a discussion in terms of what that increase should look like as we go into the next few meetings, given the fact that there is some of the sluggishness that's coming in, especially on trade, that might deviate some of their goals of expansion. But all of that, again, the Eurozone consumer confidence, the survey was at negative 2.6, came in at negative 4.4, still high, still getting back to, well above pre-COVID levels, but starting to moderate a bit, which is, again, that net positive. But then when we look at those price spikes, again, this is going to eat into confidence more and their ability for people to consume and purchase, as the Euro area manufacturing input prices remain at historic highs and selling prices are at extremes as well, and continue to move higher as they pass through that cost, limiting the amount people can buy. And this is just looking at the prices on a different level. So we want to look at it in the sense of companies across Europe are stepping up price hikes to cope with mounting cost pressures and supply chain disruptions. IHS Market showed manufacturers' costs surged in July at the fastest pace since at least 1997, while selling prices also jumped. That following warning earlier in the week from companies including ABB and Unilever that added to alarm bells about inflation. Among those hiking prices is obviously Unilever, which is everything from deodorant on down to Dutch paint maker Akzo Nobel. Again, all of these things are just driving up more prices, which is going to come to the consumer. And if you look at Germany, they have to export that. So then if you look at the euro, how expensive the euro is versus other, that's going to limit the amount they can export and the amount that they rely on China. So when you look at the share of total German exports of U.S. to China, you can see that the Chinese exports has grown while the U.S. has stayed flat to slightly down. So as China continues to struggle on the consumer side, on the spending side, that is going to bleed out and impact Germany more directly. And that's when you look, just the last thing to wrap it up, on the business activity in the U.S. and Eurozone continued to rise in July. Australia suffered a setback with the Delta variant. So when you look at what's happening right now, so the Eurozone is getting a little bit better flatlining, U.S. is starting to come down, and Australia is rolling over after being stronger then and leading the way. And that's when we're starting to get some of these pivot points where we're getting past that peak growth and you're starting to see some of these slowdowns get priced in. Obviously, Delta has the Delta variant. They have some lockdowns. We're going to talk about that in the next section because that's going to be some of this overhang. But to be clear, you saw some of the softness coming in prior to lockdowns, which is speaking to kind of this peak and what happens going forward over the next few months.